Hello, I'm David Frazier, aka the Market Monk. And this is our Market Monk show where we strive to tell you everything that you need to know, but nothing more regarding factors and developments that are likely to affect your investment portfolio. So we're recording this show on Wednesday, October 15th at around 7 o'clock in the evening. Today I'm going to discuss several issues in no particular order, and going to tell you my thoughts on some different subjects too regarding what's going on in the financial markets and ways that individual investors, like hopefully you, whoever's watching and listening to this show today, can both protect the value of your portfolio in the types of down markets that we've been encountering over the past few days and really over the past couple of weeks, and at the same time profit during the major upturns. So I'm going to talk about that a bit. I'm going to talk about some recent developments in the financial markets, and I'm going to show you how we here at Frazier and Mayer Research LLC doing business as both the Market Monk and as integrativeInvesting.com. I know that's a mouthful. To show you how we can help you. And I mean that very sincerely. Whether you choose to listen to me and follow my advice, well, that's totally up to you. Okay, first of all, I don't know how long this video is going to be. My guess is it's going to be probably about 15 minutes in length. So let's get right into it. Okay. Well, boy, gee, what a surprise. Over the past couple of days, I heard numerous so-called financial market experts, money managers, and mutual fund managers tell investors via their appearances on several financial market broadcast TV shows. I heard several of those so-called experts tell investors over the past couple of days that they should be raising cash and getting defensive. Well, first of all, let's think about what that means, that they should be raising cash. Well, how are they going to raise cash? What do they mean by that? Why don't they just tell people what they're really saying? What they're really saying is that they're now recommending that after stocks have already fallen sharply, that they're now recommending for investors to sell a lot of their stock holdings. Not before stocks fell sharply, but after they've fallen sharply. They're now telling investors they should sell some of, if not all of their stock holdings, and that they should get, quote, defensive by now going to cash, that is selling their stocks and just sitting in cash, or buying stocks of so-called defensive companies, defensive stocks, such as consumer staple stocks, healthcare stocks, that tend to not fall as much as other stocks, or I should say tend to not fall as much as growth stocks or small cap stocks during down markets, but nonetheless, those stocks still fall considerably down in down markets. So how is that getting defensive? The only way to get defensive is to go to cash. And you don't do it after the fact, you do it before the fact. Now, I know that but the vast majority of financial market experts that might be listening to this show are probably thinking right now, or telling their clients that, well, no one can time the market. That's what they always say. What they're really saying when they say that is, what they're saying, quote, I can't time the market. Well, if they can't time the market, maybe you shouldn't listen to them. And the reason I say that, I've never claimed to be able to time the market, that is determining the optimum time to get out of stocks and the optimum time to get into stocks, that is to get out at the absolute high and to get in at the absolute low. I have never claimed to be able to do that on a daily or weekly basis. But I can tell you what I have done, and I have documentation, a lot of documentation, to support what I'm about to tell you. I have been able to successfully time the market, that is to get out of stocks near the highs, very near the highs, and to get into stocks very near the lows on really almost every major downturn and upturn in the U.S. stock market for approximately the past, oh my gosh, approximately the past 15 years. And it's not because I'm necessarily smarter than someone else. It's because I do a ton of research on a regular basis, number one. Number two, I created and developed an investment timing model almost 30 years ago, during 1986 to be exact. And I've used that model since then, and I got to tell you, it was probably about approximately the first 5 to 7 years when I used that model. I had little faith in it, especially because it seemed to give me a sell sign, that is to get out of stocks, when everything seemed to be going fine. And it seemed to give buy signs to get back into stocks when things were terrible and it was the worst time. So I didn't have much faith in it for about 5 to 7 years. But since then, I noticed that model has been very, very accurate at forecasting major turning points in the U.S. stock market, really financial markets around the globe, but primarily the U.S. stock market. I don't want to talk too much about that, but that's the second reason. One, I do a ton of research on a regular basis. Two, I created and developed a model, an investment timing model, many years ago that has worked. I mean, for example, I advised investors through a newsletter that I was doing at the time during September 2007, only, I think, 3 weeks, before the major stock market indices around the globe peaked. I advised subscribers to that letter to get completely out of the stock market, only 3 weeks before stocks peaked. And I advised aggressive investors actually to sell short stocks at that time, and to continue to sell short stocks during 2008. If you're a novice investor and you don't know what I mean by sell stock short, I suggest you just look it up. Use Google to look it up. It's actually, and you'll know what I mean by doing that. Essentially, it's a way to make money in the stock market when stocks are going down. And I advised those same newsletter subscribers during, I think it was the third week of February, about 2 or 3 weeks before U.S. stock prices in general, as measured by the major stock market indices, bottomed. I advised those same subscribers to get back into stocks. And I've done that numerous times over the past 15 years. Do I get am I always right to the day or week or month? Of course not, and I'm not claiming to be. But I've been very good at this. So those folks that claim that no one can time the market, no. What they're really saying is that they can't time the market. So don't listen to those people. Okay. Now, I also heard today on a couple of broadcast TV shows, several of these same so-called experts, and some of them are experts. I mean, there are some really, really good financial market advisors and money managers. But I can tell you the vast majority, regardless of their education, their so-called credentials, their titles, the vast majority of these people are not good at what they do. Their track record just does not support in any way that they're good at what they do. And the vast majority of these people you should ignore. You should never listen to. The only thing they're going to cause you to do is to lose money. Having said that, I heard several so-called experts today on Wednesday, October 15th, tell investors on these broadcast shows, I'm looking at some notes here, it's the reason I keep looking to the left, tell investors today that they, quote, would be buying now on these pullbacks in stocks, that they, quote, would be buying. What I find very interesting about that is oftentimes whenever there's an investment portfolio manager or some type of money manager on any of these broadcast shows, they'll say that they, quote, would be buying, yet oftentimes some of these shows, they'll put up a chart on the TV screen showing whether or not that portfolio manager or economist or analyst actually is buying any of the stocks or other securities that they're telling other people that they would be buying. And it's almost, it's at least 95% of the time. It's closer to 99% of the time, and actually it's closer to 100% of the time. When we see the checkbox on those charts, whether or not those money managers themselves hold positions in stocks that they're recommending, or are buying stocks or other securities that they're recommending to people, that they're telling others that they would be buying, well, guess what? They're not buying them. They don't hold those securities, and they're not buying them. So what's this nonsense about that they would be buying them? Yeah, this is, you know, it's almost fraudulent is how I feel about it. You know, quite the contrary. I buy and sell and trade and invest in many of the same securities that I advise my clients and newsletter subscribers to buy and sell. Not all of them, because I will have my money allocated in certain ways, and some of those ways don't match up necessarily with certain of my clients and subscribers. But I do buy many of the same stocks and exchange traded funds, or sell short stocks, or invest in securities, whatever type of investment securities. Very often will buy for myself and or my firm the same securities I would recommend. So I'm not one of these guys to tell you what I would be doing. I actually often do what I tell my clients to do. So I have an issue with that. Am I a little upset here? Do I seem upset? Actually, I am a little upset. And the reason being, you know, for many, many years, well, when I first got into this business, and most people that get into the investment securities business and money management business, my experience has been the vast majority of those people, you know, well, a heck of a lot of them for sure, one of, if not their primary reason for getting into business is they want to make a lot of money. I mean, I remember interviewing about 20 years ago for a stockbroker job, and I actually was foolish enough to say, when asked, well, what's your primary reason for wanting to get in this business? And I said, I want to help people. And I was told later by a person that got me the interview at that firm that I was laughed at. It's like, are you kidding me? He wants to help people? We're not interested in hiring people that want to help people. We want to hire people that want to make a lot of money for themselves. And I can tell you that's how most of these folks are. Not all of them, once again. Of course, there are some very good guys out there that want to be helpful. But I'm a little upset because the actions of a lot of these money managers and portfolio managers and analysts suggest very strongly that they don't give a damn about you, the individual investor. They don't care about you. Oh, they'll claim that they do, but their actions don't support it. You know, and so yeah, I'm upset. I'm upset that these so-called experts have the nerve to come on national television after stocks have fallen sharply, and then after the fact, tell people that they should sell stocks and get defensive. Yeah, it upsets me. It really does, because I always have tried to help people in the financial markets, and I think I've done a very good job at it. And subscribers to my newsletters, they seem to think, and have told me on many occasions, they're very happy with the advice that I've given them. Let's move forward. Next issue. This video might even be 20 minutes, because I'm guessing we're already probably 10 minutes into it. Next issue. I also heard today, amazing, truly amazing, but it actually wasn't amazing to me. I heard on several very well-known broadcast financial market TV shows throughout the day that stocks were falling sharply today, and did fall sharply today, because of investors' concerns about Ebola. That was the reason given. Now, there were other people that actually did give more of a factual reason, which I'll share with you in a moment, why, in my opinion and experience, is why stocks really fell today. But yeah, throughout the day, I mean all day long, probably every 5 minutes, I heard people in these financial broadcast shows tell their audience that stocks were getting hit hard or falling sharply because of Ebola concerns. Well, let's think about that for a moment. For example, I'm going to go and look at all of the components of the Dow Jones Industrial Average. The Dow Jones Industrial Average was down 173 points today, over 1%. And at one point was down over more than 400 points today. And yet, when I go through the 30 components, the Dow Jones Industrial Average consists of 30 stocks. And I go through the components, and if you think about it, if Ebola concerns are what affected the decline in the Dow, well, how would that happen? And one of the primary ways that it might actually happen is if the Dow Jones Industrial Average was composed of numerous airline stocks, meaning that because of Ebola concerns, that people might become worried about getting on airplanes and might stop, reduce their air traffic, and that therefore the airline companies would have less sales revenues and therefore might lose money over the next couple of quarters. So if concerns about Ebola were to affect the major stock market indices, and we're just using the Dow Jones Industrial Average at the moment, well, if several airline stocks compose that index, well, that might in fact be the case. But guess what? There's not one airline company that is a component of the Dow. Now, there is an airplane manufacturer, the Boeing company, but I'm talking about commercial airlines such as Delta or American Airlines. Not one of those company stocks is a component of the Dow. Not one. I mean, here are the types of components of the Dow. The Caterpillar, Cisco Systems, Chevron, General Electric, the Home Depot, Johnson & Johnson, McDonald's, Nike, Pfizer, AT&T, I could go on, Walmart, Visa. In what way would people's concerns about Ebola affect those stocks? How would their concerns affect the revenues and earnings of those companies? Why would they be selling any of those stocks because of Ebola? They wouldn't be. This is nonsense. There's only one company whose stock is a component of the Dow Jones Industrial Average that I could see why people might have sold that stock today on Ebola concerns. And that's the Walt Disney Company, who has theme parks around the world. But I haven't looked at Walt Disney recently. My guess is the theme park revenues is probably a relatively small part of Disney's revenues. Disney, makes a lot of its money off movies. And you could say, well, people might not go movie theaters because of Ebola concerns. That's true. So I can see how Walt Disney and Company stock would impact the Dow today, but none of these other stocks in any way whatsoever. This has nothing to do with Ebola. This is a bunch of nonsense. These are people that don't really know anything about what's actually driving stock prices or making these kind of comments. So what did affect stocks today? What are the real reasons? The real reasons that stocks have fallen sharply over the past several days is because there's more and more and more indication that the pace of economic growth in most countries around the globe is going to slow considerably over the next few months. And if the economic growth in numerous countries around the world slows, if economic conditions therefore worsen somewhat, then that means that in general, individuals and businesses won't have as much money to spend. So individuals and businesses might rein in their spending. And therefore, other businesses that sell to certain businesses or to sell to individuals, if people rein in their spending, they're not going to get as much sales revenue, and it's a good chance that their profits are going to decline. And stock prices are ultimately determined by the level and direction of earnings, of profits. Well, they're not, the level and direction of profits of the company. So, if we see an economic slowdown, and there's more and more and more indication that, yes, we're going to see economies around the globe slow over the next several months. Europe's already going back into a recession. I don't see the U.S. going into a recession, but we're going, yes, there's plenty of indication of this. That's the reason stocks have been falling. And I told subscribers to our newsletters that I saw that several months ago. I started telling our subscribers at least 2 months ago, maybe 3 months ago, that the leading economic indicators that I follow on a regular basis were indicating that we were going to see a slowdown in the pace of economic growth around the globe. So what did I do? So then finally, approximately 2 months ago, because I was getting more indication of that, I told our subscribers to get almost completely out of the stock market. In fact, most of our subscribers follow what I call our core investment portfolio. And for that model portfolio, I told people that follow that portfolio to get 100% out of the stocks approximately 2 months ago. Now, did I capture the exact high in stock prices? No, I don't claim to be able to do that. But are any of those subscribers experiencing any of this downturn in the stock market? No. They're sleeping very, very well. They're very comfortable. While other investors and financial market participants are getting really scared here because they've been in cash for the past couple of months. They're not experiencing any of this downturn. Now, I'm going to move into a totally different area here, and I'm doing so for the following reasons. We've offered, my firm that is, financial market newsletters, numerous newsletters for the past couple of years, and actually we're contemplating getting away from that business to a large extent and to actually start focusing on providing research and advice to institutional investors, small hedge fund management companies. And I bring that up because I am going to continue to keep one of our newsletters, what I call it our flagship letter, which is Frazier Strategic Allocator, and has 4 model portfolios: a core investment portfolio, an income portfolio, a speculative portfolio, and a short-term trading portfolio. And I don't want to get into all the details of it, but I'm going to maintain that letter. But there's a good chance I'm going to stop producing some of these other newsletters. And the reason I tell you that is I really do want to help investors protect themselves and make money. I'm not in this just to make money for myself. Now, I know a lot of newsletters writers say that, especially the ones I always try to get very personable with you in the writing. And they'll tell you about what they did on a vacation, and they'll tell you how they met with their family members over Christmas. Well, guess what? I don't do that in my newsletters. I don't do that. My opinion is people who pay for my investment advice are not paying me to talk to them about my family and to get really personable with them. They're paying for my information and advice. So I just stick to the facts. I don't get into that personable stuff. Now, I find it very, very interesting that I'm very, very extremely certain of the following. And that is, very ironically, I'm very certain that I've held extremely more conversations with our newsletter subscribers in trying to help our subscribers answering any question that they ever have, that I've had personal conversations with their subscribers exponentially more than any of these other newsletter writers who claim to be personable and claim to be your friend. I'm extremely certain that I have had exponentially more conversations with my subscribers than any of those newsletter writers ever had. So in reality, they're really not as personable as they claim to be. Most of them. Once again, not all of them. Secondly, I don't lead our subscribers to think that they're going to get rich quick. No, that's not what I'm about. You can't get rich quick. You got to work hard. You got to educate yourself. You got to get knowledge in certain areas. And that's what I try to do for our subscribers. I try to keep them informed and educated. And I think I do a really good job of it. And my subscribers tell me I do a really good job of it. I also don't tell our subscribers that, this is a safe investment. Don't worry. Well, guess what? I don't do that because the financial markets are not safe. And I never am going to do that. I just tell people the facts and I keep them informed. I bring this up because I had someone tell me a few days ago that my approach in writing financial market newsletters is all wrong for the individual investors. That I needed to be personable and lead them to believe that they can get rich quick and to make them feel safe and secure. I disagree with all of that. I think the real investor, that is a person, regardless of the size of their portfolio, it might be only $10,000. It might be only $2,000. They're just starting out. Or they might have several $1 million. In my opinion, the real investor, they don't want someone to tell them that they'll get rich quick. They don't want someone to mislead them and telling them that this is safe. They don't care about someone's being personable. They're looking for advice. Okay, solid information and advice. In the same way that they go to a medical doctor to get advice if they're having some type of physical ailment. Or that they go to an attorney if they need advice on some legal concern. And that's what I do. So, if you're a serious investor, I strongly urge you to go to our internet website if you're not already there. I'm guessing a lot of you are listening to this or are watching and listening to this on YouTube. I encourage you, if you're a serious investor, if you're not, don't bother to do what I'm going to tell you to do. Okay, we only provide information and advice for serious investors, not people that are jumping around from newsletter to newsletter to newsletter in some get rich quick scheme. But if you're a serious investor that wants to protect the value of your portfolio and to also grow the value of your portfolio, I suggest you visit our internet website at www.themarketmonk.com, or also you can go to www.integrativeinvesting.com. That's integrativeinvesting.com or themarketmonk.com. Look at the menu bar, which I'm going to do now myself to make sure I guide you correctly. There's a gold color menu bar. Look over to the right, you'll see advisory services. If you put your mouse over that, you'll see individual investors. If you put your mouse over that, you'll see newsletters. Click on that. And I encourage you to subscribe to one or more of our newsletters. You can do so on a completely free trial basis, meaning you do not even need to put in your credit card for a period of 2 months. But if you're one of those persons and you think you might want to do this, I sincerely urge you to do it soon, because we're going to soon stop publishing several of these newsletters and begin to focus on the institutional investor. I think that's all that I have. Just looking over my notes here. So I kind of went all over the place there. I know that's a long video. Hopefully you've gotten something out of it. And I can tell you, my research indicates that there's a decent chance that we're going to see somewhat of a rebound, although I think it'll be modest, in U.S. stocks on Thursday. But even that's questionable. There's other indications that stocks are going to continue to move lower tomorrow. I'm not sure. I'm never sure. I'm never 100% sure. I make logical, probability-oriented bets, if you will. But what my research is showing is that stocks are going to continue to trend lower over the next couple months. So thank you for listening, and I'll speak with you again soon.